Good afternoon, everyone. Thank you for joining us. Today we have an update with Talisker Resources CEO Terry Harbort. The company announced that it has signed binding terms for an ore purchase agreement last week. The format of today's session will be Q&A. Thank you to those that emailed questions in. We have those ready to go. And if you have questions throughout the session, please enter those into the Q&A box at the bottom of your screen. And as always, before we begin, today's presentation will contain forward-looking statements. You can find those in the presentation on the company's website. And thank you, Terry. Welcome. Good to see you.
Magda, thanks very much for having us back. It's been quite a long time, a lot of change and a lot of exciting things at Talisker. So really good to be back here and having a webinar with our shareholders.
You've had a busy few months for sure. So we're going to just start off with the funding strategy. So one of the first questions we got from the shareholders was with the ore purchase structure and the revolving credit facility in place, how does this change Talisker's funding outlook, and what does that mean for potential equity dilution?
I think, Margaret, it changes things in a couple of ways. The first one is it gives us backup security of capital. So if we face any challenges or we want to accelerate any development or any drilling or something like that, then we aren't fully constrained to having to go back to market in what could be a vulnerable position or in challenging times when there isn't good available capital or we can't get a good deal. Really, we have that credit facility in the background there for a backup for those sort of eventualities. What does it mean for potential equity? Well, we're hopeful and always been working towards a plan that we can become self-funding very quickly. And we're certainly following that plan now of ramping up our production, nearly at break-even point. Usually something that can take 1 to 2 years. So I think our team will be quite proud if we can achieve that within a year. It's something quite anomalous in the mining industry. So yeah, look, I think it certainly gives us the possibility that we might be able to avoid further equity dilution as we ramp up and strengthen our cash position. But certainly at a minimum, what it means that if we at some stage do have to look for equity, we don't have to do it in a vulnerable position. And perhaps we can delay that further down the line. It's quite a significant amount of capital, $25 million US. Really to be able to expend all of that, I think we'd need something incredibly disastrous. So more than anything, it's as a backup plan, and I think it really strengthens our financial position and gives us a much bigger runway with our current plans.
For sure. And just looking back at the past 6 months, can you speak to the rationale behind the fundraising strategy over those past 6 months?
Oh, sure thing. Look, it's all been driven by accelerating our plan. And anyone that's seen our corporate or me give a corporate presentation over the last 3 or 4 months, it's all been about accelerating our profile, our production profile, accelerating our development, bringing more drilling online so we can justify increased mine plans, a second mine. It's all about growth. Really, for the last 2.5 years prior to sort of March, April this year, there was no available capital. And really, that's why we're on the capital markets. That's why they're called capital markets, because they're for raising capital. But I think ourselves and our peers have really struggled prior to that. The last 2 years were very challenging. There was a lot of redemptions from our traditional funding sources, our traditional institutional shareholders who fund us and help us to grow the companies. And they were in a fairly tough position themselves. This year, mass inflows come in and we were able to take capital and accelerate the plan beyond our original bootstrap plan. And I think by mid next year, we'll really be seeing the results of that decision to move forward and move forward faster. And I have to thank our significant institutional shareholders for coming to the table and really backing and supporting our plan to move faster and capitalize on what's still, despite a $400 haircut this last couple of weeks, what's still all-time high gold.
Thank you. And taking a look at the mine and production, can you help investors understand how this new structure with the ore purchase agreement, how it transforms Talisker from an early stage producer into a scalable and cash flowing gold company? And why is that shift not yet reflected in the market?
I'll answer the second part of that first, because things take time. Things take time, and we need to execute and deliver on our execution. So, the market reacts when you move forward, and the last significant re-rate we had was when we went into production. We had gold sales and we had revenue. So that was a really significant part. So it will be reflected, but perhaps this question's come from a retail shareholder who may expect that markets are going to react like they used to 20 or 30 years ago. And I don't think mining markets react like that now. They're not reactive to speculation or to big, bold news. They more react to execution and de-risking of projects. So all as I can say is that, yes, I think it will be reflected in the market, but we have to execute and we have to follow the path that we have been following. So the first half of that question was, I think, relative to what it brings to the table for Talisker. So I think one of the challenges that we had initially with trucking and milling material with Nikola was simply scalability, and also time relative to scalability. Nikola certainly has plans to increase their milling capacity. However, it wasn't really parallel to our growth profile, particularly our new growth profile. So we want to produce faster, we want to mill more material. So as many of our stakeholders on the call will know, I've been actively looking for multiple other opportunities. We previously had an agreement with New Gold, and as we step forward and find a new agreement, we move away from the old agreements, and we're constantly looking, how can we improve our economics, and how can we improve the benefit to Talisker shareholders long term. And really this step forward here with Ocean Partners really helps us achieve that. So it unlocks or removes the cap that we had on our production profile. So it allows us to scale intimately up to 1,500 tonnes a day. And then even with ore sorting, it might give us an effective mining rate of double that, perhaps up to 3,000 tonnes a day. At this stage, we don't know whether we can mine at that rate. We've still got engineering and scheduling design work to do. But it allows us, if we can, if the engineering and the geology supports that sort of production rate, that we can actually work towards that. So I think that's really one of the main benefits here. It scales us and takes us away from a struggling small tonnage producer into one that can really grow and maximize the full growth potential that the great Braylon asset provides to us.
So thank you. No, it definitely unlocks a lot of that upside. And can you walk us through the key operational milestones between now and the first ore shipments under this framework, and how confident are you in Talisker's readiness to deliver at scale?
Oh, again, I'll answer the second part of that. Yes, I think we are confident. Otherwise, we wouldn't be doing it. We've really delivered on all of our promises over the last 5 to 6 years as a company, and we certainly have no intention of not being able to deliver on these. And of course, we'll face challenges. We always do, but it's the ability to find or resolve those challenges that really helps us go forward. What are the milestones? Well, look, I'll bring a few other points in here, because really it's a three-pronged combination of various milestones that really builds this strategy. And the first one of those is increase in our permitting, and we're in the process now. We've just submitted a increase of permitting rate of 500 tonnes per day. We expect to have that in about mid next year. That'll allow then, with the implementation of our ore sorter, an effective mining rate of 1,000 tonnes per day and a trucking rate then, or a milling rate of 500 tonnes per day. So we're well underway, and I expect there's probably some questions here somewhere in your list about ore sorting. So I won't talk too much about it, but we're at this stage working on the earthworks for the ore sorting. We're working on the design of the facility, and it's a fully fledged processing. So there's not just an ore sorter. There's a hopper, there's a primary and secondary crusher, there's a screener, there's a wash plant, there's 2 ore sorters, and then there's a tertiary crushing facility that crushes it down to the size, about an inch, that we'll be trucking to Ocean Partners. So really, all of those 3 components fit into this strategy. And depending on timing, some of these things can be standalone or just 2 of them at once. If we have the ore sorter before we have the increased production permit, then we can double our current production rate by using ore sorting. If we have the permit first, then we can target high-grade material and truck that until we've got the ore sorter in. So it really allows us to have a multifaceted approach, and when they all come together, then it has a significant, really massive impact on our economics and what we're producing.
Thank you. And Terry, just touching on the mill. So does the company still plan to build its own mill? How would that enhance margins and value creation? And then I see an audience here about how long would it take permits to build a mill, and how long before we apply?
Yeah, sure. So I'll answer that in multiple components. The simple answer, Magda, is yes. Of course, we are going to build our mill, simply because we won't have to truck or pay somebody else to mill. So it's really straightforward why we'd improve those economics. Why we've taken the approach of offsite or toll milling or ore purchasing is to build a capital pool that'll allow us to implement that mill using our cash flow. So being able to avoid as much as we can, more equity, more dilution, without having to go to debt and pay that back. Usually in this time period, it's those of us who have heard of the Lassonde curve, very famous curve of companies losing a lot of value while they're in the permitting and construction and financing phases of building a mill. So we're fortunate with our strategy that we don't have to go through that. So we don't have 3-4 years where we don't have any capital coming in, and you end up with a depressed market cap and you've got to raise money at really challenging positions. So we're able to avoid that because we can get into cash flow very quickly and actually build up a cash pool. And at this stage, we're certainly pretty confident that we can self-fund building this mill ourselves. Ultimately, that's why we look at our own mill, and also gives us scalability. To have a look at some of the timelines, really, I'd rather talk about the whole process as opposed to just the permit, because it isn't just something that it isn't totally dependent on the permitting. Really, there's an engineering phase that comes in, that's site design, looking at your power requirements, looking at your milling process. So there's increased metallurgical studies to do. There's also trade-off studies and right-sizing studies, looking at what the size of that mill is. So all that needs to be completed prior to when we would submit a mill. Again, we're taking a bit of an innovative approach with that. We expect that the ore sorter will give us a lot of benefits with right-sizing the mill. So instead of requiring a very large mill, we can look at a smaller mill, perhaps half the size of what we traditionally need without ore sorting. That means half the power requirements that we need to turn that as well. Less or smaller mineral processing materials and metallurgical materials. Our metallurgy, we're doing our metallurgy, additional metallurgy. We do have a lot of historic metallurgy, but really a lot's changed in the last 50, 60, 70 years since a lot of this metallurgy came in. A lot of great technologies come in and a lot of efficiencies, particularly on the flotation side. So we're actually doing that now. That's part of the phase 2 of the ore sorting study that we've done, to look at that very high grade material, and look how the metallurgy relates to that. So we're in the process. So there's multiple things moving in parallel. Things don't necessarily have to be in serial. So we can move these things in parallel. We'll have some changes to our management plans as well that needs to be updated. And in British Columbia, there's a series of 15 management plans that really define how you operate and how you manage things such as tailings, such as water, such as waste. So there's 2 significant updates there. The first two will be a redesign of our tailings storage facility for when we have our own mill. And at this stage, we're likely transitioning again into new technology. So old technology utilizes wet tailings, so tailings held in a dam underwater in an anoxic environment, so the material can't decompose and release certain elements into the environment. More new technologies coming in is looking at dry stack or filter pressed tailings. So that's where we get a big filter press, and a filter press is, if people have olive oil, it's like a massive olive oil plant that squeezes all the material out. And then instead of putting that underwater, we build a hill. So we build a mound. When that's finished, it's resoiled, regrassed, trees are planted back on it, and it goes back to environment. So that's one alternative that we're looking at. And the second alternative is using a paste material or paste backfill. So that's where we create a slurry and we can pump that back underground and refill areas where we've extracted material. So either in stopes or in development drives that we're not looking at using again. So that's a very good technique because it minimizes our surface disturbance. It basically puts things back underground. We try and put as much waste as we can back underground. So it minimizes what's left on surface, because on surface then we've got to resoil, reseed, plant trees, put organics back on, so that all adds into mine closure costs. And all of that needs to be, we had a look at. We'll also be increasing our waste storage capacity. So there's work that needs to be done there about where that waste is going to go, how we manage water, how we manage rock stability, geotechnical studies. So they're all very important things. There's been some very famous cases, particularly this year, both here in Canada and also in Brazil and other countries, where there hasn't been very good geomechanics or rock stability, and it's had significant impacts on operating projects. So all of this stuff needs to be done first prior to us submitting the permit. And then, of course, the government has to review that permit. Before the government also has to go through our First Nation partners, and they need to review and comment, and the government needs to review and comment. And ordinarily that can take anywhere from sort of 14 weeks to 18 weeks, because there's an awful lot of things to read through. It's like a 1,000-page document that needs to be prepared and implemented. In our experience, the government's been excellent. British Columbian government, there seems to be a perception that permitting is challenging in British Columbia, and certainly that hasn't been what we've seen. The government's been very proactive, very useful, operated a lot of or offered a lot of advantages of quicker pathways. So I think that's very good. So really, we're looking at about a 2-year time frame. We're planning here for a 3-year time frame. So if we can submit this by mid or towards the end of next year, that'll take us to 28 or 29. And I think that's a realistic time frame. There's no point me telling everyone on this call what's unrealistic because it makes everybody happy. I'd rather tell you what's realistic, and then we can deliver on that. And there are some things that we can achieve prior to that. There's a pre-permit construction work, so we can actually advance things such as construction, earthworks, electricity, non-operational components. So all of this can be done in the lead up to receiving that permit, so you're ready to go.
Awesome. Thank you. And just touching on the Ocean Partners Agreement one more time, what steps are still needed to get to the definitive stage?
So there's some due diligence that needs to be conducted by Ocean Partners. They've already conducted a fair component of that, including a site tour and access into the data room. Now it's just looking at our current financial model, and really that's all from their side. There are some other agreements that need to be done. Our royalty partners, Cisco Royalties and Sprott Streaming and Royalties, they'll sign an intercreditor agreement based on the credit facility. Ocean Partners has fairly good templates with that and has worked with both of those groups before, and the deal's been well socialized with both those groups, so we don't really see any challenges there with that. And really, that's about all that needs to be done. So again, we've laid out a 90-day timeline there for that. But if all goes well, we expect that to move much faster than that. But again, I'd rather tell everyone 90 days, and if we get it done sooner, all the better.
Got it. Thank you. And just touching on the logistics as well, how does this agreement work with a potential ore sorting scenario? Can you give us an overview of where the pre-concentrated material would go?
Yeah, so in general, what the ore sorter will do will help us to reduce waste material that gets mined with the veins. So we do two types of veining, if you like, of mining. One's lateral development, so that's development along the veins to get access, and that's generally about 3 or 3.5 meters wide. And the vein within the middle of that can be anywhere from 1 to 2 meters. So the ore sorter removes that material, either low grade or waste material with no gold in it whatsoever. So it means we're not trucking and milling material that doesn't have any value for us. In addition, when we're mining the veins, we generally mine between 1.5 and 1.8 meters. So if the veins are narrow but high grade, so 40, 50, 60 centimeters, a meter, but carrying high grade material, we don't suffer the dilution for when they mine outside of that. And again, either lower grade or waste materials incorporated with the vein material. So it allows us to just take the high grade veins. At this stage, from the first study and second study we did with ore sorting, we expect about a 50% reduction in the waste on our ore material, and probably about a 50 to 60 or maybe more on our lateral development material. So that brings the grade up because we're not diluting with rock that has no gold in it. So we're expecting as well to see an increase in the grade, and that increase will be anywhere from 70 to 100% increase. So likely we'll be trucking grade that's in the range of sort of 15 to 20 or 22 grams.
Thank you. And I see a question here. Are you able to speak to any of the expected costs of using Ocean Partners in terms of shipping and milling?
So the milling part of it's a little bit challenging to talk about on a per ton basis because it's a payable based on total contained ounces or gold within the rock. So as opposed to us paying per ton, they pay us by the number of the amount of gold that's in the rock. So it's a range in the agreement depending on the grade. At the bottom end of it, it's around the 86%, and the top end it's in the mid 90s, sort of 93.5 percent payable, and that's not on recovered gold, but on total gold that's in the rock, and it includes the milling and the processing. We're having a look at some avenues for the trucking now, potentially using rail as a component in that. It is further to truck to the Vancouver Wharf or Vancouver Harbour than it was over to Merritt. So there is an increase, I think about $40 a tonne or so on trucking, but we are looking for other avenues to be able to reduce those costs. One of the biggest costs of core is having the ore sorter and being able to reduce the total volume by 40 or 50% with it that we're trucking.
Thank you. And do you know when you would consider moving ahead with the purchase of an ore sorter? And if there's any particular updates on the testing process?
Sure thing. So we're in the queue now for the manufacture and delivery of the ore sorter, and we're finalising the design and the feasibility component of it. Basically, we need to build a big sprung structure and bring all that equipment in. So we're finalising all the quotations with our metallurgical or mineral processing consultants with ABH. So they're just finalising that. We expect here within the next couple of weeks we'll have that material. I think from an economic perspective, we've already made the decision that we will be going forward with the ore sorter. The testing came back very well. However, before we finally pull the trigger, we need to complete all the technical and scientific work that will back that up. So that's metallurgical work based on that. We're also doing some milling index work on that as well, and we're doing multiple tests on the assay of that material. So initially we've just done fire assay. We're looking at some gravimetric and some photon. We're investigating having a photon at site. So we just want to compare those three just to make sure that everything's in line and everything really supports the implementation of the system.
Got it. Thank you, Terry. And kind of taking a bigger picture at kind of the plans and the upside, touching on the second mine development, Olympus, would this development be contingent on the construction of an on-site mill?
Yeah, that's a pretty good question. I don't think so. What may change is the rate that we're trucking and mining. Certainly, if we have our own mill and an ore sorter, the cut-off grade's much lower because we're milling a lot less material and it's much higher grade. So it would certainly change the mine plan. There's quite a significant amount of high grade material in Olympus, and we'll be targeting that in these earlier phases of trucking and ore sale or milling, simply because we can justify a higher cut-off grade. But ultimately, we want to mine more gold, and we want to mine as much as we possibly can from the complex. So in that case, I think it certainly justifies bringing in our own mill. But at this stage, yeah, I think we'd certainly we certainly would go ahead with Olympus, whether we had our own mill or not. At this stage, what our strategy is to parallel the permitting of those two instances of the mill and the new mine. Really, we want to avoid having too much burden on the government. The government doesn't just deal with us, the permitting branch. They deal with a lot of other operational mines and mines to be operational. So what we want to do is minimise that and have those two permitting requirements dovetailed so we can move them along as fast as we can.
Got it. Thank you. And kind of given today's gold price and Talisker's production plans, why do you think the market hasn't recognized the underlying value yet? And what milestones should investors watch for that could drive a re-rating?
Well, I think we have had some re-rate. We've gone up 300% in the last couple of months, so I don't think that's a fully true statement. As we continue to grow, the major milestones really are um, resource increase, PEA coming out, increased production profile, and transitioning from um, cash flow negative into cash flow positive, and then building up a cash pool. So at the moment, all our excess capital cash, if you like, goes into more development because we're in the growth phase. We're in the ramp up phase. So we can't really expect at this stage for us to be generating gobs of cash because all that cash goes back into development. So I think they're the main milestones that we're committed to executing. And really, in between some of that are some intermediate milestones that help all that occur, and that's all sort of coming in what we've done here with Ocean Partners, and of course all our permitting. So they're related to those big milestones. Um, and really, I think the market's been everyone's been pretty undervalued for the last couple of years, and everyone's starting to come out and find those proper valuations. And really, I'm talking here at an EV per ounce scenario. And previously, prior to the last couple of years, EV per ounce for inferred material was probably $50 an ounce. For indicated was probably 80 to 120, and we've seen levels of 12 to 15. So I think we're just in that process. Having gold come off $400, $450 doesn't help in that pathway because there's a lot of reactionary selling that is certainly reflected by changes in the gold price. But I think most people on this call are probably reasonably confident that the outlook for gold over the next 2 to 3 years is very good, and certainly we believe that as well. We balance our economics conservatively with sort of 33 short term and 28 long term, but I'm certainly hopeful that gold price will remain high, that we'll hit our milestones and have significant re-rating as we hit them.
Thank you. And I just see a couple of questions here. Can you give us an update on the mining rate today at Braylorn, and how are you targeting a ramp up into the end of Q4?
I'll answer that a couple of ways. Our daily rates, I guess, variable. It's up and down because it depends on whether we're in stope material or whether we're in development ore. So we're mostly in stope material now. So we're probably mining and trucking between 200 and 250 tons per day. We'll be mining 2 stope fronts simultaneously throughout November and December. So basically, we have a cross cut that comes in, and then we develop both ways. So we'll be trying for the second half of this year to be able to push out as much material as we can, and then by sort of next year be in that Q1 sort of in that 300. 250, 300 tonne per day. And then as we complete the development across the Braylorn West, and we're planning there sort of end of Q1, then that'll allow us to implement that ramp up towards 500 by the middle of the year.
Got it. Thank you. And another question here. Congratulations on the progress. Are you able to discuss the payables received from Ocean Partners and how those might compare to similar agreements?
The answer to that is yes and no. Look, I'm happy to give you a range, but obviously Ocean Partners and other groups who are trying to do similar things to Ocean Partners like to keep those payables under wraps. Will sort of come out in a revenue sense in our quarterly financial statements, in our yearly statements. But I can certainly give you a range based on grade ranges. And for lower grade material, and probably the minimum we'll be sending, sort of 5 grams per ton, it's in the mid 80s, so sort of around the 86 mark. And then with high grade material, it increases up to a top is 93.5% of payable.
Got it. Thank you. And touching on exploration and geology,
Mm.
with a resource update plan for 2026, how much has been drilled this year and how much is planned for next year? Is this an infill campaign resource or is it targeting new mineralization?
So our main focus this year and next year, Magda, really is on infill and supporting the mine plan. So we'd like to build out a 3-year runway of the mine plan. It helps our engineers with design and helps us with efficiency. So a small program this year, mainly because we weren't planning on doing any, but with additional capital, we're able to bring that forward. It's about 12,500 meters worth of drilling being done both from underground, so underneath where we are at Mustang. So that'll be targeting the 1045 and 1030 levels that sit under where we're currently working. If anyone's a bit lost, please have a look at our corporate presentation. You'll see the slide there of Mustang. So it's down below where we're currently mining. And then the second area that we're drilling out is across at Braylon West. So we're of course expecting to have that development done, and we'll be starting to mine there in the second half of 2026. So the majority of work's being done there. The resource update, most of that will be coming from some historic material that we've been able to validate, and we're working on the process with our QPs to bring that into our resource and bring that into the mine plan. Much of this is based on drift assay work, so drifting at 50 meters apart. So it's likely to be at inferred level because of the spacing. And then we'll likely come back and drill that in between each of those levels to transfer that into indicated.
Got it. And Terry, can you speak to how has the mineralization mined reconciled to the resource to date?
Yeah, look, it's been interesting, Magda. It's reconciled quite well to the block model. We have had some challenges with nuggety gold. Often when we do cut channels across the face, it may not hit zones of high grade gold. However, the geologists who are mapping the faces, when they see a series of visible nuggets or visible gold in the face, then we've had to re-look at how that sampling comes back and how that relates to the block model. So it is a natural system. It is a gold system, orogenic gold system. So we do expect this high level of variability. We we do expect the nugget distribution, because we do have quite a bit of coarse gold. Fortunately for us, where we see the sulfide fractures, the cracked seal, and fine-grained sulfide, the gold's fairly consistent across those bands. And if anyone is struggling with what I'm talking about, the final page of our corporate presentation, or the page that has the contact details, shows a good example of that within the quartz veins. So there are always these challenges in a nuggety gold deposit, and they really give you more challenges when you're at a small scale. So it's quite stressful for our grade control geologists, dealing with block model, dealing with nuggety gold, and also dealing with recoveries out of the mill and back calculating what our grades are. Also in our early phases, we had quite a bit of material that was lateral development. So it is impacted more by dilution, and that dilution can be variable. At some stages, it can be 2.5 meters, others it can be 3, others it can be 3.5. So again, that's always something that's a bit challenging in the early phases of the mining. But all in all, it's gone well. Our mining contractors have been doing a very good job. The veins have been behaving quite well on average. So that's minimizing overbreak and minimizing dilution. And that really helps to build in with that block model reconciliation. With the new resource coming up, we're working with our QPs to understand the impact of the ore sorting and the removal of the majority of the dilution and what that has to do with grade and what that has to do with reconciliation. So it's quite new. We're relying on some good consultants to help us with this. It's something that's not common, but it's something that will become commonplace as ore sorting becomes commonplace in mining throughout the world.
Got it. Thank you. And Terry, I see an audience question here. Can you talk about the expected PEA, expected release date, and will it be using a new method as an Ocean Partners?
Yes, simple answer to that question. So it'll be a PEA in the sense that the majority of the resource we have is inferred. However, the costs, the milling structures, the ramp up, it'll all be based on our current mine plan, our current contracted costs, the built-in payabilities, the metallurgy that we have. So it'll have a much higher level of confidence than a normal PEA because it'll be beyond feasibility. It'll be our actual mining rates that'll be going into these analysis. So it'll be very similar to our mine plan and our economic study. It'll just be signed off by an independent, and therefore we'll be able to submit it out to the public. But certainly all costs. This is what we're doing, and this is what we're going to do in the future. So it'll be utilising all of that information. We'll be simply calling it a PEA because it's using the bulk of our resource, which is at inferred category. Sorry, to answer the question there on timing, we're just finalising with the QP now, the external, the people who are actually writing the report and validating everything, what the process is. But expected timeline is it'll be about a 6-month process from now. So that'll put us probably into early Q2.
Got it. And Terry, switching gears into more corporate topics, a question that came in Monday morning, I believe, from a shareholders. What does the core acquisition of New Gold mean? Can Talisker defend against being acquired? They'd rather be an independent company for ideally forever and build out the next New Gold.
Okay, yeah, look, interesting. Always interesting to see big companies consolidating for economies of scale, and that's certainly what this deal looks like. It's a relatively close to market all share deal. So it's really putting assets together more than anything. What impact it has on us, I don't really know. New Gold had pretty well disbanded their M&A strategy a couple of years ago when they stopped participating in capital raises or financings with us. What Core's long-term vision is, I don't know. We talked to a lot of strategics, and several years ago we certainly had talked to Core, so they do know what it is we're doing, at least in the early phases. Or we haven't spoken to them for a couple of years. I don't know if they have a regional consolidation strategy. I don't know. Maybe that's a question that person can ask them and see what that is. Can we defend against being acquired? I guess that really depends on our core of institutional shareholders. Certainly, institutional shareholders are very supportive of what our vision and our mission are: to develop multiple mines, to target 200,000 ounces, to build our own mill, to build out a district scale, hopefully mid-tier gold producer. So I think they're committed to that. Otherwise, they wouldn't have offered us the bought deal that just came in. From anyone who doesn't know what a bought deal is, that's when shareholder groups come together and make you an offer for capital. So I think at this stage, certainly they like what we're doing. They believe in the team and the vision. So I think they probably would defend us. But it all comes down to what the offer is. If it's an absurd offer, then it's something that goes to the shareholder vote. And myself as CEO can make recommendations as to whether I think it's a good idea or not. At this stage, I wouldn't think it is. I think we can grow. We're on a good path. We can certainly get very quickly than most groups to self-funding. So I'd certainly look to them to help us defend it. Whether or not we have that same plan in 5 years' time, once we've built our second or maybe our third mine, once we've built and commissioned our mill, but potentially once we're a dividend paying, if we take that path and we haven't got things to reinvest in, then it might come down to are there synergies that have value for our shareholders? And is a premium to where we are something that would be attractive to everyone on this call and our institutional shareholders? So at this stage, I don't know. We'll build it first, and then we'll worry about that.
Thank you. And how much Talisker did New Gold hold as of the most recent filing?
The most recent SETI filing?
Yeah.
I'd expect it was 0. So New Gold sold off their entire shares in Talisker just a couple of months ago. They owned at that stage 9.8%, and they sold that to the Phoenix Gold Fund and the Pinar Fund, both I think out of either Singapore or Malaysia. Sold that out at 52 cents. So prior to they were out of Talisker well before the core transaction took place.
Got it. Thank you. And would Talisker consider acquiring other assets to build up a production base?
I think we'd always consider a good deal, Magda. I've always been adamant up until now that we think Braylawn's a world-class asset. So we've always struggled with overinflated valuations of other assets because we don't want to dilute what we think's a world-class asset with things that may have a limited growth potential. Obviously, for the right deal, for the right price, of course, we'd always look at it. We do have others of our own assets that we're starting to look at. What have we got to do to bring them online? And Ladner, of course, is the first one of these. We acquired it at the time when the parent company was in a distressed state. Now that gold's booming, I don't know if anyone's in a distressed state. So we really have to take opportunities at a case-by-case basis because it might be challenging to get a good deal for our shareholders. It might cause undue dilution if we need to merge with somebody that would dilute us 40% to acquire an asset. It's really something we've got to look at from an economic perspective and where it fits in our own growth profile. So I think we're pretty well on a good path here with Mustang, then with Olympus, and then potentially with Congress down the line. So we've just got to value that out. Are we better off putting our capital into things that we can bring online in the next 5 years, or putting something that we might have to park because we don't have people, we don't have capital, or we don't have permitting or power or whatever it is relative to those projects? So I certainly can't give a definitive no, but at this stage, I think it's not something that we're actively doing.
Got it. Thank you. And I believe this is the last question for you, Terry. Can you comment on the recent issuance of RSUs and options to board and management?
Sure. I'll give the same answer, I think, that probably every CEO in the world gives when this question comes up. And it's all relative to remuneration of our staff. Salary packages all around the world generally consist of a base salary, short-term incentive and long-term incentives. These in particular were long-term incentives. They're to keep people with the company and to motivate them to be innovative, work very hard, and not jump around with other groups. The long-term incentives, ours, vest over a 3-year period, so they don't get paid out. They're specifically designed to keep people within the company and to drive them to work as hard as they can so they can realize that value after a 3-year period. This fits in with our stock option plan. The stock option plan has been approved by shareholders. And really these plans or these issuances are based on extensive industry peer group review. In our case, these peer group review are done by independent advisors. So it's not done by us. It's not done by the board. It's done by somebody external. They review a large amount of peers and what the range and medians are within those groups. So they don't compare us to Barrick and Newmont. They compare us to groups who are in the same stage that we're at. And they either do it using published reports such as the Bedford report, or they look at the MICs or the financials or annual reports of each of these companies. So very robust data that gets done and put together. Then all this goes to the compensation committee, and the compensation committee reviews it. Generally, they take out outliers and then make a decision on it. So all this helps us to sit within an industry standard. There's always comments about remuneration, and well, if people think good people will work for nothing at the top of the gold market, then you're really sadly mistaken. And if your view is that Talisker shouldn't pay their people or should pay them below industry standard, then you can't expect us to build a company that's above industry standard with below standard people. And the adage is if you pay peanuts, you end up with monkeys. And well, look, I'm not prepared to do that. And it's a small amount of issuance, small amount of dilution to keep good people at the top of the market. So just to be clear to anyone who's missed it, this is the highest bull market of all time. We're seeing so many projects come out of the woodwork, come online. We can't compete on a base salary basis with major producers, or at this stage, even with intermediates. We can only compete with our peers. And having these instruments allows us to be able to do that. So we can bring people in like Richard Morrell, like Lindsay Dunlop, like a lot of the people we have operating on site, the engineers, the shift bosses, because we're competing against the rest of the industry. And it's all about people. It's people that make mining industry work. It's people that make good projects be able to grow and develop. We also ask a lot of people, particularly our geologists, to give up significant intellectual property. Their ideas on geology, their ideas on new projects. We have to remunerate people for that. Otherwise, they go and form their own companies and we don't get benefit out of that. So that's my response to that. Look, I'm sure every CEO gets asked these questions, and every CEO around the world comes back with the same answer. This is what we have to do to retain good people and get good people to come across to us so we can build the companies that all of our shareholders want us to do.
Thank you, Terry. I see a comment here from the audience. My thanks to you, Terry, and to the whole team. I don't see any further questions. If anybody has any other questions, please email info@adcap.ca. Was there anything else you wanted to cover today we didn't get to?
No, Magda, just apologise to everyone for not having more time to do more of these webinars. Certainly, my plan is to try and do these on a monthly basis, so we can address a lot of the news. We've had a lot of news coming out, and there's a lot more news to come. So I'll try and do that. This is prime marketing season for mining CEOs coming into December. So we've got a lot of travel on, a lot of conferences, getting the story out there. Many of you would see a lot of the webinars and interviews coming out. So I'll do the best I can. Hopefully here coming into December we'll have another one, and we'll also have some more gold sales to talk about, and some really good drill results, I think, from the project that Kyle's undertaking.
Excellent. Well, thank you, Terry. Thank you to the audience, and have a great afternoon, everyone. Thanks again.